Hey, this is Arthur Hill, Chief Technical Strategist at trendinvestorpro.com. You are tuned into our YouTube channel for our weekly video analysis. If you like this video, please give us a thumbs up and consider subscribing. So today we're going to dive into the Trend Composite. I'm going to compare the 125-day Trend Composite to the 200-day. We'll look at the signals on the chart and the indicators, and then we're going to backtest this using SPY to 2000. And just a little bit of housekeeping. There will be no show next week or in July. We're going to take a little summer break, and I will return in August with a new format. Have a great summer, everybody. So one of the biggest challenges when you're putting an indicator on a chart is setting the parameters, the time frame. How many days, weeks, whatever do you want that indicator to cover? You know, if you're in the trend following mode, you're going to want something longer, more than 100 days. If you're in the mean reversion mode where you're looking for pullbacks, you want something in, say, the 10 to 20 day range for your indicators. I'm going to focus on the trend side of the indicators, and that would be 100 plus days. And I'm going to use a trend composite, and I want to show the difference between 125 days and 200 days. And even though it's a big difference, 75 days, the signals are not that different, but the 200-day looks a little bit smoother. So this is a default trend composite here set at 125 days. And I've got the indicators on there for you. So we have the red lines are the Keltner channels. The blue lines are the Bollinger Bands. And we can see the settings over on the left here. Bollinger Bands 1 with 1 standard deviation above and below. That 125-day moving average. Keltner channels, 125-day EMA with 2 125-day ATRs above and below. And so these indicators trigger when you have a break above the upper Keltner line or Bollinger Band, and they trigger bearish when you have a break below those lower lines. And they're currently both bearish because you can see we're well below these channels right now. Then the other indicator is the Commodity Channel Index. That's in the middle. It's the CCI, and it's 125 days. And when it gets above 100, it's bullish. And it doesn't turn bearish until it gets below minus 100, which it did in January. And it's been bearish since January. And then I've got the direction, the trend of the moving average. This is a 125-day moving average, and it's the 5-day rate of change. And you can see it's a little more whippy than the others. When it goes below zero, the moving average is falling. When it goes above zero, the moving average is rising. But currently, the moving average is falling. And then I've got Stoke close here, which is also a little bit more volatile than the other ones. It's basically telling you the range of the current price relative to the 6-month high low. So if you're up near 100, you're making 6-month highs, which we were throughout this uptrend into 2021 and beginning of 2022. And now you can see we're down at the lower end. So we're making 6-month lows here in May and June. So this indicator is bearish. So all 5 indicators are bearish, and that means the trend composite is bearish because all 5 are bearish. Now, if you look at the signals here, we got a bearish signal there in January. I'll put on the crosshair so we can identify the exact date there. So there's the crosshair, and that's on January 24th. We got a little bit of a whipsaw. Whipsaws are unavoidable. If you find an indicator that doesn't get whipsaws, give me a call. But if anybody has that, they're probably not sharing it. But you can see you got a whipsaw here with a short uptrend, but it turned down on April 19th. And that would have kept you out of most of this decline. But the main thing is all these indicators are bearish, and that means we are in a downtrend for the S&P 500 SPDR SPY. So next, I'm going to just look at the trend composite with the 2 different settings. So here I've made some adjustments, and I put all the indicators on 200 days. And by the way, if you're interested in the trend composite, down at the bottom here, right, you have the plugins icon, and there you can see the Trend Investor Pro Indicator Edge plugin. And then over on the left at the top, you can open up the chart settings window and then scroll down to see there's all the indicators available in this plugin, including the ATR trailing stop. And then at the top, you can see there the Trend Composite indicators individually, and then you can click on the Trend Composite to change those settings for the individual indicators. And so what I've done is I've changed all of them to 200 days instead of 125. And so we can see here that, we're above both the upper Keltner channel line, the upper Bollinger Band for quite a long time. That's a strong advance. And then we got below the Bollinger Band there, the upper Bollinger Band, a couple times. And then we started breaking below these lower bands there I'll put the crosshairs so we can identify those, in February. So that's when the Trend Composite started turning bearish in February. It's later than the 125-day. And you can see these other indicators turned bearish except for the 5-day rate of change for the 200-day. It did not turn bearish until April, late April, and it stayed bearish. So you're going to get fewer whipsaws in these indicators when you lengthen the time frame. Now, if you look at the Trend Composite as a whole, we still got this whipsaw here in the early April period, but it did turn bearish again on the 19th as well. So it turned bearish a day early on the 18th, and it has stayed bearish. So longer term, they're both bearish. And now we're just going to isolate on the Trend Composite to compare the two time frames. So here I've got the two Trend Composite indicators. The first one, 125 days in that indicator window, and then just below it, 200 days. And we can see with 125 days, we do get an earlier signal there in late January. And then we got the signal with the 200-day Trend Composite in the latter part of February. Both of them got a whipsaw there in late March, early April, and then both of them turned bearish around the 18th, 19th of April and are currently bearish. And then if we open this up a little bit and we look at some longer term signals, we can see here that if we see that the Trend Composite turned bearish in early March using 125 days, but it wasn't until a little bit later, March 9th, for 200 days. That was during the COVID crash. And then the 200-day Trend Composite there in the bottom window turned bullish on May 29th, and the 125-day had a whipsaw. It was bullish in early June, but then bearish, and then finally turned bullish in July. And that's what you get with shorter time frames. You get some earlier signals, but you also get more whipsaws. And here your signals are going to be a little bit later, but you'll get fewer whipsaws. And the only way to really know the difference is to test. And we're going to back test both of these right now. So first, let's look at buy and hold for SPY. And I just included dividends in this back test because you're going back to 2000 here. Dividends do matter when you go back that far. So we're going to test from January 1st, 2000 to June 23rd, 2022, or yesterday's close. And this is just buy and hold. And you can see buy and hold. The SPY was up 283% over that time. And looking at the bottom there, you can see the compound annual return, 6.16% per year. But look at the maximum drawdown, 55%. And so this is part of the reason why I like to use trend following indicators is to avoid that drawdown. And so if we look at the equity curve, the green is the equity curve, the blue is buy and hold, which is the same thing. We'll be doing comparing this buy and hold to the next equity curves when we test. So you can see here, you're basically flat for 10 years. Up until 2012, you weren't making any money in the stock market until you broke out of this huge range. And then you can see we had big drawdowns in the bear market into 2003, March 2003, into March 2009. And also we had this big choppy period in 2018, and then the COVID crash in 2020. And now we've got the pullback happening right now. And so if we put all those together, we can see the drawdowns here. And there are the drawdowns that you're experiencing in your equity if you're just buy and hold. You know, you had 2 drawdowns that were in the 50% range. So you would have been down 50% in your portfolio twice from 2000 to 2010. The COVID crash, you would have been down around 33%. And currently you're down around 21%. And so we're going to compare this to the trend following signals on the Trend Composite now. So here we've done a test here for the Trend Composite using 125 days over that same period. And if you look at the bottom there we can see the details. Compound annual return, 6.85%, beats buy and hold. The drawdown, the maximum drawdown, 22%, much better than buy and hold. 11 winners and 7 losers. So not too bad. And if we put this on a chart here to see the equity curve, you get a visual picture of it a little bit better here. But there you can see there is buy and hold, the blue line. And this is a Trend Composite 125. And you can see it's outperforming all the way until you had this monster rally in stocks from the middle part of 2020 to the middle part of 2021. And now we're both coming down. So it's keeping up with buy and hold, but it is doing it with lower drawdowns. If we look at the drawdowns here, we can see that there was a very sharp drawdown in 2003. That was the 21% drawdown. But if we look at the drawdowns since, they've been capped in that 14% area. Even in 2008, your drawdown was 15%. So you had much shallower drawdowns using the Trend Composite with 125 days. And now let's look at 200 days. So I left up the 125-day results here, and you can see that we basically had 11 winners and 7 losers, 18 trades. And now I'm going to look at the 200-day Trend Composite, and I'm going to hit back test. This is 200 days, and you can see right away there are fewer trades. There are 8 winners and 6 losers, so there are only 14 trades. We look at the compound annual return, 6.73%, which is comparable to what we saw with the 125-day. And then the maximum drawdown was 20%, which is also comparable. So not that big of a difference, but let's look at the equity curves and see if there's a difference there. So here's a quick comparison. This is the 125-day Trend Composite and the equity line. And then if we look at the 200-day Trend Composite and the equity line, we can see that it was out up until 2003. And then it participated in the advances, was out during the bear market, and is performing in line with buy and hold. But now let's look at the drawdowns. If we look at the drawdowns here for the 200-day Trend Composite, you can see this big drawdown is missing in 2003. This is the 125-day Trend Composite, and you can see it had its big drawdown in 2003 and then smaller drawdowns here. Whereas if we look at the 200-day Trend Composite, it avoided that big drawdown, but had 16% drawdowns from 2008 until 2022 this year. So the drawdowns were a little bit bigger during this period. But overall, the performance is pretty much equal. If you want fewer signals, but you want to live with bigger drawdowns, go with the 200-day. But if you want more signals and you want to have smaller drawdowns, just a little bit smaller, go with the 125-day. But either way, the average compound annual return is about the same for both. So if you'd like to know more about trendinvestorpro.com, you can click on the link in the description below. If you like this video, please give us a thumbs up and consider subscribing. Thanks again for tuning in, and I'll talk to you again next week. Have a great day.